Thank you for coming along today. I'm hoping you all get a lot out of this presentation today. So my name's Cameron Kusher. I'm the Director of Economic Research here at REA Group, and I'm going to give you an update of what we're seeing in the Tasmanian housing market at the moment. If, as we go through, you've got any questions, please pop them into the chat or the Q&A function in the Zoom. What I'm going to start with, though, is a bit of an economic update to give you an idea of where things are at the moment, and then we'll talk about how that's going to impact on the housing market, and then we'll look specifically at what's happening in Tasmania. But let's jump into it. So, at a national level, the economy is actually really weak. Economic growth, you can see over the past year, has been just 1.1%. If we look over the past 30 years, it's averaged 3.1%. So economic growth is less than half what has been typical over that 30-year period. You can also see that there has been a rapid deceleration of growth. If we were to look at this data on a per capita basis, so that's on a per person basis, economic growth has fallen for 4 consecutive quarters. Now, in the history of this data set, which goes back to 1974, we've never seen 4 consecutive quarters where GDP per capita has fallen, which again just highlights how weak things are, but also the fact that it is largely the strong rate of population growth coming into Australia at the moment, which is driving the growth in the economy. If we have a look at some of the other data that is included in the national accounts, firstly, we've got the household saving ratio, and you can see that the household saving ratio at the moment is just 0.9%. Again, 30-year average is much higher at 4.8%. And the amount we're saving has dropped dramatically over the last few years. During the pandemic, we were saving around 25% of our income, and that's because it was very hard to spend. You couldn't travel. A lot of things were closed. People weren't going into offices. Now that things are back to normal, people have spent that money, both because they want to go and live their life and have those experiences, but also because inflation has taken off and the cost of living has really surged. You'd have to go back to before the global financial crisis to see the household saving ratio as low as it is at the moment. On the right there, we've got household consumption. Now, household consumption is spending, and household consumption makes up about 50% of economic growth. Over the past year, household consumption has grown at 1.3%. That's less than half the 3.2% it's grown at on average over the past 30 years. So households have really tightened their belts, they're spending less, they're not able to save as much. And that's because we have seen that rapid increase in inflation. So inflationary pressures are easing, but over the most recent quarter, the March quarter, we did see an uptick in inflation, both headline inflation, which is everything, and underlying inflation, which takes out the more volatile items, rose by 1% after slowing for the previous quarters. On an annual basis, you can see that underlying inflation is 4%, headline inflation is 3.6%. Inflation on an annual basis is meant to be in the target range of 2 to 3%. So it's still outside of that target range. Now, there's a lot going on at the moment. Government's offering lots of subsidies and cost of living relief, and certain state governments are providing these as well. What that is likely to mean is that headline inflation falls back into the target range over the next few quarters. But once that support is removed, we'll see inflation jump back up again. So what the Reserve Bank will be focusing on is that underlying inflation, and it's still way too high at 4%. So whilst inflation is elevated, there is a risk that we could see further interest rate increases. It's certainly not our base case. But if inflation is persistent enough that the Reserve Bank thinks that it will push back the timeline for getting inflation into the target range, they will lift rates further. And if we look at what's driving inflation, you can see here that services inflation is proving to be much more persistent than goods inflation. Now, that's something we're seeing right around the world. In terms of services inflation, you can see that the strength is insurance, It's also education, it's also housing, and it's also alcohol and tobacco. So insurance costs are going up so much because housing costs have gone up a lot. So, go and have a look at how much it would cost to replace the house you live in. You'd be very surprised at how expensive it is. But also, we're seeing natural disasters on a more regular occurrence as well. So premiums are going up quite substantially. Education is indexed, HEX at least, is indexed to inflation. Inflation has been really strong, so education costs have gone up a lot. But we've also had a lot of overseas students coming into the country, which has increased demand for inflation and pushed up prices. You've then got housing. Housing inflation was strong mainly due to the cost of building a new house. That is slowing its growth, but at the moment it's rental inflation which is really driving things. And one of the reasons why we're not building enough housing is that inflation and interest rates are high, so it's harder to make that new housing stack up. So again, higher interest rates would probably exacerbate that problem somewhat. And then alcohol and tobacco, you've got an excise increase each 6 months, and that excise is indexed to inflation, and inflation's been high. So that's why those prices have gone up a lot. Elsewhere, you can see that higher interest rates have certainly slowed inflation. Things like recreation and culture, furnishing, household equipment, clothing and footwear. People have really reined in their spending there, and less demand for that has meant that businesses haven't had the ability to put up prices as much. So the cash rate at the moment sits at 4.35%. Now that's the highest it's been in 12 years. And you can see that how we got here, we got there in a very short period of time. Interest rates were increased very aggressively. Interest rates have now been on hold since November of last year. And the base case is that interest rates will remain on hold, with the first cut now looking in terms of the futures market. So there's people that bet on interest rate futures. They're saying the first cut won't be till July next year. I think it might come a little bit earlier than that, but I do think it's going to be next year. And I think this is going to be tricky for the market because a lot of people were banking on interest rate cuts coming around September, October of this year, as was priced in only about 2 or 3 months ago. So the expectations of when the interest rate relief is going to come has been pushed way back, and that is going to be a challenge for some households. The labour market is still really tight, and it's really been the strong point of the economy. So the unemployment rate at the moment is 4%. The long-term average is a 5.9% unemployment rate. The unemployment rate's been below 4% for about 2.5 years now. You would have to go all the way back to before the global financial crisis to have previously seen the unemployment rate below 5%. So the labour market is very tight. You can also see the participation rate is pretty much at record high levels at 66.8%. There's two ways to look at that. The tight jobs market has attracted more people to work, or you could look at it as the cost of living crisis has meant that people that were outside of the labour force, either not employed or not looking to be employed, have now had to go back and find jobs because they can't afford not to be working. We can also see that the annual change in the number of employed persons is still strong, up 2.5% over the past year, but it has slowed. What we are finding is some signs of weakness in the labour market in that part-time employment growth has been much greater than full-time employment growth. So businesses are saying, well, does that job need to be a full-time job? Or can I get by filling that with a part-time role? Which then brings us to the underemployment and the underutilisation rates, which are both very low. So underemployment measures people that aren't working as much as they want to be. So that could be someone working part-time that wants to be full-time, or it could be someone working 20 hours a week that really wants 30 hours a week. So that's what the underemployment rate measures. The underutilisation rate is the combination of the unemployment and the underemployment rate. Now, both are very low on a historic basis, but again, you can see that they're swinging higher. And you can see the annual change in hours worked was up only 0.6% over the last year, and there's been a rapid deceleration of that growth, again, pointing to the fact that we're seeing more jobs coming on as part-time jobs as opposed to full-time jobs. So there's definitely some signs of some weakening of the labour market, but it is still very tight at the moment. A further sign of that weakness is what's happening with online job advertisements. So they're down 21% from their peak. Nationally, they're down 15.5% over the past year. Tasmania, though, is the outlier. It's the one state where online job advertisement numbers are higher than they were 12 months ago. You can see they're up 3.8%. At a national level, there's still a lot of jobs available, but it is in a clear downwards trend. And with the weak economy, I think a lot of businesses will be looking at over the next 12 months, well, do we need those jobs that are advertised? And I think the other thing we'll see is as people leave roles, businesses will go, well, do we need to replace that role? Maybe not. The tight labour market, though, has led to an increase in wages. So at the end of last year, wage growth was 4.2% for the year. It has slowed to 4.1% in the March quarter, but you'd have to go back to 2009 to see the wage price index increasing at a faster pace than what we are at the moment. The other good part of this news is that for the last 2 quarters, annual wage growth has been stronger than annual inflation. So households are actually getting real increases in their income, which hasn't happened for about 3 years. So people will stop feeling like they're falling behind and their wages are actually making up more than enough for how much the prices of goods and services are increasing. Bringing us then to the lending environment. So over the past year, new mortgage lending has increased by about 25%. Refinancing is down about 16%. Why is refinancing down so much? Interest rates have stopped changing as regularly, so people aren't shopping around for a new deal. And we've seen far fewer people over the last 12 months expiring from fixed rate mortgages. So not as many people have needed to refinance out of necessity. It's more of a choice now for refinancing. In terms of new lending, a big rebound over the year. It's been mostly driven by investor lending, which is up about 35%. Subsequent buyer lending, so upgraders or downgraders in the market, and first home buyer lending, both are up about 18% from where they were 12 months ago. So there's a rebound across the board, but it's been investors where we have seen the biggest rebound in lending over the past 12 months, at least at a national level. What we're looking at here is the cost of, firstly, the materials that go into housing construction, and then we're looking at the outputs. So the outputs are things like the civil construction costs and the cost to actually build a property. So since the beginning of the pandemic, inputs or material prices for housing construction are up about 34%. You can see they're still growing, but there's been a rapid deceleration of that growth, only up 1.3% over the past year. The output costs for houses are up about 42% since the beginning of the pandemic, and it has slowed, but you'll notice that the annual rate of increase has started to pick up over the last couple of quarters, and it's the same for other residential, which is units. Now, those prices are only up 25% since the pandemic, but up 7% in the last 12 months alone. What does this all mean? The cost of building a new house, which is always at a premium to existing homes, that premium is much wider than it has been in the past. So people are preferencing buying existing homes rather than new homes because they just can't justify that price premium that someone's seeking for a new property. Also means, as a result of that, you get less new housing. And you can see that playing out here. So the annual number of dwelling approvals is the lowest it's been in about a decade, right at the time when the federal government wants us to build 1.2 million homes over the next 5 years. I'm yet to come across anyone in the industry that thinks that we'll be able to build those 1.2 million new homes. I think planning is getting a lot of the blame, and planning is certainly a problem and needs to be fixed, but the higher interest rates are the big thing that are driving the difficulty in delivering new housing. With higher interest rates, your development finance, your construction finance is more expensive. With higher interest rates, there's fewer people to buy the properties to get the pre-sales you need to go and start construction. And then obviously you've got labour and material costs, which have escalated a lot as well. So the price of new is at a much larger premium than it typically is. So these are all challenges limiting the ability to deliver the new housing that we need. You can also see this playing out in commencements, which are also at about a decade low. So if you're not getting an approval, you're not going to get to the start. There's still a lot of housing under construction, and that's mainly because there's projects that have stalled or there's projects that are taking a lot longer to complete than they were before the pandemic. because you have those shortages of materials and labour. Unfortunately, though, the population of Australia is increasing really rapidly. We need to be building more homes. So natural increase, which is births minus deaths, over the last year, it's been the lowest on record. So we have an ageing population and we're not having as many children. Most of the population increase has come from net overseas migration. So the population of Australia increased by about 650,000 people last year. That's a 2.5% increase of total population. 85% of that population increase came from net overseas migration, and pretty much every state and territory has seen record high levels of net overseas migration over that period of time. Let's have a look at some of these stats for Tasmania. So the unemployment rate in Tasmania is 4.1%. The long-term average unemployment rate at 7% is much higher than what it is nationally. So we've got a tight labour market in Tasmania. Job creation, though, has been much weaker. You can see that the number of employed persons is actually down 0.7% from where it was 12 months ago. The underutilisation and underemployment rates are higher in Tasmania than they are elsewhere. You can see they're trending up, but again, well below that long-term average. And the annual change in hours worked, well, there's been 4.4% fewer hours worked over the past 12 months. Again, just highlighting that job creation at the moment in Tasmania is nowhere near as strong and people are working fewer hours overall. If we look at the lending environment, so subsequent buyer lending in Tasmania was down 14.2% from a year ago. It's very volatile month to month. First home buyer lending was up 16%, investor lending was up 18%. So all of them, or each of those three, have seen a weaker year-on-year increase in Tasmania than what we've seen at a national level. But the strongest rebound has certainly been the first home buyer segment and the investor segment. Dwelling commencements, very low in Tassie. You can see not decade lows, but quite low. There's still a lot of housing under construction, but that pipeline of new housing coming through behind has really thinned out quite significantly. And if we have a look at the population increase, all of the increase in population in Tasmania basically is due to net overseas migration. We're seeing a large outflow of people from Tasmania when we look at net interstate migration, which has reversed what happened in the years prior to and during the pandemic. So, we're not seeing that strong population growth, but net overseas migration has been at pretty much record high levels over the last year, albeit you're only looking at about, about 5,000 people over the past year. So where to for the economy this year? So that table on the right shows you the current forecasts from the Reserve Bank at the moment, which they update each quarter. But some highlights: we only have economic growth for the first quarter of this year. We think that the second quarter is going to continue to be quite weak, but then things will start to improve over the second half of the year. Now, I say improve, I still think that economic growth is going to be very weak historically, but it is going to increase a little bit. Main reasons: tax cuts have been broadened. There's been more support for households around rebates and things like that. Inflation is still high, but it is lower than it has been over recent years. And also the impact of the interest rate hikes we had over the last 24 months eases the further away we get from interest rates moving. Inflation, I still expect that headline inflation will drop into the target range, but underlying inflation is going to remain outside of the Reserve Bank's target range. And as a result of that, interest rates don't look like they're going to be reduced this year. That's looking more of a next year prospect. The labour market probably weakens further. The unemployment rate will drift higher. Job creation will slow. Some of the labour shortages we've had will wane, and businesses will slow down their hiring in response to the persistent weaker economic growth conditions. Wage growth has peaked, as I mentioned, but wages are expected to continue to rise at a faster pace than inflation, which is good for households. Housing construction remains in the doldrums, and nationally we think that construction this year will be worse than it was last year, which was already a really bad year. And population growth is likely to slow from the record high levels we've seen over the past few years, but it's still going to remain very high on a historic basis, which is problematic when you're not building much in the way of new housing. So where do we think things are looking like in the established housing market? Let's have a look here. So what we've got here is we've broken Tasmania into what they call SA4 regions. So you've got Hobart, you've got Launceston and Northeast, Southeast, and the Western Northwest. Over the past 3 months, you can see prices are lower in Hobart. They've been falling for several years now. Prices are down about 9% in Hobart from where they were at their peak, whereas outside of Hobart, you can see moderate rates of price growth over the last 3 months. It's kind of a similar story over the past year. We've seen a decline in prices of 1.9% in Hobart. The magnitude of those price declines has slowed, still falling, but falling at a slower pace. Regionally, Western Northwest is seeing the strongest price increases. The Southeast is seeing moderate declines. So prices are down 1.9% over the year in Hobart. If we look elsewhere, so if you go to Sydney, prices are up 7%. If you go to Melbourne, prices are up about 1%. If you go to Brisbane, they're up about 13.5%. Adelaide, 14%. Tasmania, not Tasmania. WA in Perth, prices are up 20% over the past year. So Hobart is certainly lagging behind, but price growth in Hobart through the 2010s, particularly the later part of the 2010s, was much stronger than it was in those other states and territories, which is really important to remember. If we look over the past year at how houses versus units have performed, so house prices are down 1.9% in Hobart, unit prices down 2%, and house price growth in regional Tasmania has been marginally stronger than it has been for units. That's a pretty similar trend whereby the unit market has narrowed the gap in growth to houses, but is still underperforming house price growth. So if we look over the past decade at how prices have increased, you can see each region of Tasmania for houses have seen prices double over the past 10 years. The Southeast has seen the strongest increase, 123.8%. Over the past 5 years, quite strong growth in regional parts of Tasmania, but we have seen relatively lagged growth in Hobart, 40% for units, 46.5% for houses. Again, though, Hobart, one of the best performing, Hobart and Tasmania, one of, if not the best performing market for price growth over the past decade. So yes, things are weak now, but it comes off a really strong period for growth over the, particularly the first 5 years of the last decade. One of the challenges that Hobart is facing at the moment is that there's a lot more stock that's available for sale. So you can see here, new listing volumes in Hobart are 7% lower than they were a year ago, but they're comfortably higher than they were on average each May from 2018 to 2022. They're up 7.5%. And this is also being replicated elsewhere across the state. You can see Launceston and Northeast, slightly more properties on new listings than a year ago. The Southeast, quite a lot more new listings than a year ago and well above that 5-year average level. You can also see this playing out when we look at total listing volumes. They've shot up quite a lot. So in Hobart, you can see the number of new listings, total listings was already very high last year, and it's up another 7.5% this year. It's 65.5% higher than it was on average in May for the 5 years to 2022. And you can see that being replicated regionally as well, particularly in the Southeast and to a lesser degree, Launceston and the Northeast. The Western Northwest supply is up from a year ago, but we haven't seen as big of a magnitude as an increase compared to that 5-year average. But the general gist of this is there's more stock on the market in Hobart and in Tasmania at the moment, and that's certainly one of the reasons why prices have been falling. There's less demand, and there's a lot for buyers to choose from. We can also see this playing out when we look at sales volumes. So sales volumes, you've got more stock on the market than a year ago in Hobart, but you've seen sales volumes fall by 1.7%. Sales volumes are only marginally higher in Launceston. The West and the Northwest is where we've seen the biggest increase in sales volumes relative to last year. So a bit mixed throughout the state, but generally speaking, the lift in sales or the change in sales has not been enough to offset the change in the amount of stock on the market. And I think the point here is for vendors, you need to be really aware of that. You need to set really compelling prices if you want to sell your property, or you really need to be willing to adjust to meet where the market is. And if we look at our measure of demand, which is inquiry per listing, you can see that at the moment we're getting an average of 5 inquiries per listing in Hobart, 3.2 in regional Tasmania, and it's down right across the board. Western Northwest has seen the smallest drop over the year, but inquiry levels are now lower than they were before the pandemic. So again, it's a much more challenging situation across Tasmania to get a property sold now than it has been over recent years. And I think vendors really need to get their head around that situation at the moment. Which then brings us to the median days on site, and you can see that it's quite high as well. So days on site in May this year was 60 days in Hobart, 90 days in the Western Northwest, 83 days in the Southeast, and 72 in Launceston in the Northeast. A year ago, you can see it's higher across the board. It's well above that 5-year average. If you look at the 5-year average for Hobart, you're talking about 33 days, which is reflective of how strong things were between 2018 and 2022, and just how much things have changed. Again, a lot of this is being driven by the fact that there's less demand, but there's also just a lot more choice for someone looking to buy a property across Tasmania at the moment. They don't need to be rushed into a decision. So what do we think this means? Firstly, at a broader sort of context about the housing market, the last few decades, we've seen really strong price growth, and that's been driven by interest rates falling from 20% to nothing. That's significantly boosted people's borrowing capacities, and they then chose to spend more on housing and push up property prices. That's probably not going to happen again. Credit availability, credit availability was loosened through the 90s and early 2000s. It's tightened over the last 10 or 15 years. You go and try and take out a mortgage, it's very intrusive, the questioning that you get. The banking regulator, APRA, is stepping in and changing serviceability buffers, putting caps on credit growth and things like this, and none of that is likely to go away. So finance is definitely harder, or credit is harder to access than it used to be. And I mentioned earlier that employment participation is pretty much at record high levels. A lot of that increase has come from more women joining the workforce. So as more women have joined the workforce, household incomes have increased and people have been able to borrow more for property. Again, we're probably not going to see that boost again going forward. So given that, the one thing that is still really strong is migration. It is becoming a little bit more, there's a bit more conjecture around there. But migration certainly drives demand for housing. But I think at least 3 of these 4 drivers is unlikely to be as strong going forward. So that means that it's probably going to be a situation where property prices don't rise as rapidly going forward as they have over recent decades. But in saying that, we have seen interest rates rise really rapidly, and even in Hobart, although it's not as strong in Hobart and Tasmania as it is elsewhere, the level of housing demand is somewhat surprising given interest rates are the highest they've been in 12 years and how quickly interest rates rose to that level. We have seen a big increase in the volume of stock for sale, but nationally we've seen an acceleration in price growth. In Tassie, we've seen a deceleration of those price declines. So the market could end up being better this year than it was last year in terms of price growth. There is a lot more stock though, so there's less fear of missing out from buyers. I think a lot of people will go, well, I don't want to overpay. If I don't get this property, something good is bound to come onto the market in the next couple of months. So vendors need to be very realistic about that. And they need to be realistic on adjusting prices or setting the right prices, because people can be a lot more selective in a market like this. We need to build more housing, but the high cost of new housing is likely to see people continue to preference existing homes. It's also likely to see them prefer properties that don't need a renovation as opposed to those that do. Infill housing, probably not as big of an issue in Tasmania, but the cost of housing in certain areas, in the more desirable areas, has got very high right across the country, and we do need to see some more medium and higher density in those areas to give people the ability to live in those areas at a cheaper price point. And, the high cost of renting, which we're about to get into, is likely to see more people that have the capacity to do so to become first home buyers to exit that rental trap. Although rental conditions, again, in Tassie are somewhat different to what we're seeing elsewhere in the country. So let's look at the rental market. So the only area that saw rents increase over the past 3 months was unit rents in the West and Northwest. Each other market across the state saw rents fall. Tasmania, Hobart had very expensive rents several years ago. It's now the cheapest capital city in the country in which to rent, with a median house rent of $550 a week. If we have a look at how that's played out, you can see that rental growth has really stalled over the past 12 months. In Hobart, you're looking at $510 a week typically to rent, $430 a week in regional Tasmania. And you can see that things have flattened out, although the southeast has still seen rents rise 7.1% over the year. If we look at how that plays out, houses versus units, so neither house or unit rents in Hobart have increased over the past year. The standout has been unit rents in the West and Northwest, and it's been the house rents in the southeast, but much more moderate growth than what we're seeing in most other parts of the country at the moment. So over the past 5 years, rents in Hobart are up 18.5%. They're up 43% in regional Tasmania. Hobart in particular, it was the first 5 years of the past decade where we saw the really strong rental increases. Rents are up 70% over that period of time. And you can see in the southeast, Launceston, we've actually seen stronger rental growth than what we've seen in Hobart over that period. Rental yields. One of the big things through from about 2017 onwards that was attracting a lot of people to Tasmania was prices were rising, but rental yields were really strong as well. We have seen a big drop off on rental returns. Now they're starting to improve a little bit, but 4.3% rental yield, you can get better yields than that in pretty much any of the non-Sydney and Melbourne cities around the country as well. So you're not going to be attracted to Tasmania for the rental return in this current market. And obviously price growth is not happening at the moment as well. So it's a bit of a harder sell for investors in Tasmania than what we're seeing in other parts of the country. New rental listings. So in Hobart, they are down from where they were a year ago, but they are up 26% from their 5-year average. And you can see elsewhere, we're generally seeing fewer new listings than a year ago, but generally more stock than that 5-year average level. And if we look at total rental listings, again, they're down over the past year, down 16% in Hobart, but they're still 31% higher than their 5-year average. In the southeast, down 6% over the past year, but 76% more properties available for rent than on average between 2018 and 2022. So there's just a lot more choice for renters in this market at the moment. Rental inquiry per listing is actually higher than it was a year ago, which is a little bit surprising. So you're seeing in Hobart 14.2 inquiries per listing and 9.7 inquiries per listing regionally. So a bit of a bounce back in rental demand. But go back to before the pandemic in Hobart, and you were seeing, 30, 40 inquiries per listing. So it's certainly dropped off quite significantly. And if we look at the supply of rental stock, rental vacancy rates, still reasonably low, but they have jumped over the, it's very volatile month to month, but they're certainly a lot higher than they were through the early parts of the pandemic. And if we look at rental days on site, it's 23 days in Hobart at the moment, 26 a year ago, but it is higher than that 5-year average. And somewhere like the southeast, you can see 48 days as the median days on site at the moment. So it's definitely a lot harder to rent out properties in that market at the moment. So where do we think the rental market's going from here? Now, rental prices, not so much now, but previously were rising in Tassie, mainly due to a reduction in household sizes through the pandemic and that low level of housing construction, although Tasmania has certainly never been a real powerhouse of new housing construction. And we've had rapid population growth, mostly from migration, which has driven demand for rentals. In a lot of parts of the country, the problem now is the capacity to pay the price that someone is seeking for a rental, and that's probably still a bit of an issue in Tasmania, given how much lower incomes are generally in Tassie than they are on the mainland states. How do people respond to this? Pardon me. They look to rent in less ideal locations. That's something we're seeing right across the country. They move to smaller properties. So if you're in a 4-bedroom house, you might move to a 3-bedroom house, or you might move to a unit. The other one we're seeing a lot more of is people having, not out of want, but out of necessity, to go into share houses. And that's a trend we're seeing more and more at the moment as well. How do we address what's happening in the rental market? Well, you need more supply. That takes a lot of time. Even if we fixed everything now, it would take a lot of, 3-4 years to build the housing we need. So what you really need is more people investing in residential property and making that stock available for rent. On the demand side, you can lower migration, which federal government's talking about doing, but it's very difficult to implement that. You can boost rental assistance, which they've done in each of the last 2 budgets. They hadn't done for 20 years before that. Or you can encourage more people to become first home buyers. Not always, but a lot of people becoming first home buyers will be exiting a rental property and making that available to rent for someone else. And I think that we should see more investors returning to the market. And as I said earlier, I think we will see more renters exit this market and purchase. So that's a rundown of what we're seeing in the Tasmanian housing market at the moment. I'm going to stop sharing my screen. We do have a poll that is about to pop up, and hopefully you can answer that. But I'm also here to answer questions. So if there are any questions, please pop it in the chat or the Q&A, and I will try my best to answer it. If you don't want to ask a question now, feel free to get in contact with your account partner and they can pass on any questions to me. But hopefully you did find this useful. Hopefully there's some messaging there you can use with your vendors or with potential buyers. And if there aren't any questions, I wish you all very good luck for the next 6 months, and hopefully the Tasmanian housing market continues to improve like it is, unfortunately pretty slowly, but hopefully things continue to get a bit better for you down there.